All right, guys and gals, welcome to another weekly edition of Mindful Money. All right, your host, Prince L. It's good to have you guys here. I appreciate your time, your energy, your presence. And we've been having these conversations around estate planning, but today we're gonna kind of some of the things that maybe you didn't know, or maybe you have questions towards about what is possible with your estate planning. Okay, now everyone's financial level and savviness and intelligence or literacy is different. So, there will be no shaming, right? We're gonna have a conversation that's designed and geared towards helping any of the attendees tonight find a solution. Okay, so what we've been talking about in the past couple of weeks are trusts and the benefits, right? Well, if you couldn't see this stuff before, you certainly can see it today. Let's get that right. Boba. There we go. Right. So some of the things that we talked about when in regards to estate planning and trusts and benefits, things that some of you guys may have already been familiar with. Oh wow, like why is the font size just changing? Here we go. So we talked about credit. Okay. Why would credit matter to a trust? Well, a couple of reasons. Authorized user accounts, right? Why do you keep doing that? Why you do me like that, baby? Why you do me like that? Okay. So it doesn't, what is happening here? Credit authorized user accounts. Okay. This is a way of passing on good payment history from one responsible credit user to someone who needs to build some credit, right? So say, for example, when would an authorized user account be good and useful? Well, let's consider planning for a minor, right? Trust can be used for the benefit of a minor as well. And the way that that would happen is through what's called a custodial trust, right? So somebody is basically acting in the best interest of the beneficiary who at the time may be a minor, okay? Now that minor may want to start developing some credit, because hey, people still use credit today for, not only applying for credit, also applying for loans, but also your credit score can be a determining factor for employment. It's not supposed to be, however, it is used as an indication of responsibility. The better the credit score, the more likely this person is to be responsible on the job, right? Do you want to pass that type of responsibility onto your children and make it easier for them to also benefit from years of good credit history? I mean, maybe even for someone who looks at a family structure, they may say, well, this person is only 18 or 23 or 32, but they've got almost 50 years of payment history. How is that? Maybe because mom and pop may have been intelligent enough to say, you know what, let me make sure that our child, you know, who's 7 or 8 years old right now, can go ahead and benefit from having credit in the future, right? So aside from authorized user accounts for our children or for like grandchildren or for loved ones, because if you are of a in a higher age bracket, we'll say it like that, right? Then you are also in a lower tax bracket. And so, you know, hey, you may not need to worry about credit anymore, but these youngsters in today's day and age, they do. Okay. So custodial, custodial accounts, right? Hey, in the event that we're not here to take care of our children, someone who's going to act as a custodian or a guardian over the trust for a minor, they'll be able to do that. What kind of credit will the minor have? Well, the trust itself can also have its own unique independent credit score, right? Or their Fair Isaacs Corporation, aka FICO score, will look much more appealing to creditors in the future, right? To employers in the future, okay? And the trust can be used as a way of protecting the beneficiaries from overspending or, like irresponsible actions with the money, okay? So we got custodial accounts. We talked about this very briefly. Other things, right? And guys and gals, feel free to stop me because again, this is a conversation. And if you got questions, I definitely want to answer those. Okay, so we got some comments in the chat. There's a touchy thing. I put my daughter on my credit of 782 as an authorized user. She failed to understand the difference between her obligation to pay it back versus the credit she was allowed. She just never got it when it came to paying it back. Felt she had the good credit, so didn't need to pay it back. Still hasn't, and my credit dropped to 680. Jeez, 100-point drop. Well, I mean, if you authorized her, you also have the ability to unauthorize her.
Mhm.
So something, we talk about the authorized user accounts, but oftentimes, like, we don't really block the smart thinking, very intelligent thinking, block the cars. Yeah, for those who may not feel that the who they're authorizing as a user on their account has the financial responsibility, yeah, block the card or put them on the card, never give them the card, and you use the card responsibly in a way that will still benefit them. Okay, but yeah, that's a tough one. Thank you for sharing that. You know, yes, and speaking of which, something else that we talked about last week was the importance of understanding the 30% credit, not credit, because this isn't Credence Clearwater Revival, CCR. Credit utilization.
Oh, yeah.
All
Mm.
right. So we got to kind of talk very briefly about the 30% credit utilization. All right. And we did talk about that last week and a couple of weeks ago
Mhm.
too, because once you use more than that 30%, that credit score drops. All right.
Mhm.
And that now it may be possible to still do more than 30%, but you have to repay that back quickly as so that it doesn't negatively affect your credit score. Okay? So now if you have a business, your business can definitely go the route of using more than 30% because your business is thinking about annual services, annual expenses, not monthly expenses. So this is where after we talked about the 30% credit utilization, we talked about the importance of an annual service or product versus a monthly service or product. Okay. Month to month, there are more service fees usually, right? For anything that you might purchase. So if you've got a, if you let's go ahead and put some numbers to this. If you've got $2,000, well, excuse me, let's just say that you got $1,000. Let's just do that, right? 30% of 1,000, 300, right? Very easy math. We're not gonna make this complicated. You got somebody caught me. I had to stop and say, wait, let's make this easy math so I don't look like a schmuck. Right? So what we want to do is I want you guys to really think about the difference between using credit for something that is one-time expense for the year, right? Like for a business, website hosting. Maybe you want to get a website, right? If the website costs you $150 and then maybe you still got $150 budget left over before you get over that 30% threshold, right? What else could you do? Well, you don't have to use the remaining difference. I don't want anyone thinking, oh, I got 30%, I got to use 30%. No, you don't. Okay. This is about planning out the longevity of what you want to do. Okay. And part of the reason why we're talking about this with it as it relates to trust is because, well, most businesses fail within the first 3 to 5 years. I want you guys really thinking about using a trust as an unincorporated business association to figure out over the first 3 to 5 years before maybe you decide to actually incorporate with the state of residence that you might be in or the country of residence that you might be in. Because, hey, I'm happy to say we've gone a little international today. We got people from outside the country on this call. And that's thank you for those that, who you are, right? But the first for if you're thinking about financial planning and about like not just making money, but also like what you're going to do with the money, like how's that going to affect you in a couple of different ways. Number one, biggest expense is tax, right? We got to think about the tax implications that are going to come along with how you use your credit or your money to fund whatever business venture it is that you have in mind. All right. So I really want you guys thinking about this. All right. 3 to 5 years. Oh, well, I don't want to wait 3 to 5 years to get incorporate my business. That's cool too. I just want you to understand what the failure rate is and what the time period is for that. I don't want anyone thinking, "Oh, I'm going to start my business tomorrow, and I'm going to become a millionaire overnight." And hey, I am not one to pee in anyone's Cheerios. Okay, nobody wants that. Okay, I think it'd be a much better option to go with some coconut milk or some cashew milk, not the other thing. But what I don't want anybody to kind of run off thinking about getting into business and not having an actual plan in place. The number one destroyer of most business plans is not a business plan, but a failure to plan, which is basically a plan to fail. So I want you guys out of the cycle and out of the mindset of failing because you have not done all the necessary planning. All right. Sometime, and it's my experience within the last 10 years that, well, people think about a business, they think about marketing, they think about social media, but they don't think about their expenses like taxes. They don't think about protecting their investments, right? They don't have anything that protects their income either. All right. Some of the first things that you probably want to get taken care of are those business or life essentials. All right, guys. I had you know, earlier today, one of our other partners and I, we were having a meeting. And, you know, I'm happy to say, not to boast, but to express that, our business is starting to grow. Our business is also starting to touch income levels of all sorts. So I'm happy to say that, this business partner and I, we were on a call today with, I think, the second millionaire or second $1 million income earner, um, just on an F&A, all right, a financial needs analysis. And this woman, 23 years old, she's got two line streams of income. One comes from a 9 to 5 regular job. The other one comes from a 5 to 9 online hustle, right? Now, I want you guys to understand something. From her nine to 5, group term life insurance, 401k plan in place, she's good, right? On her employee benefits, she's good. Maybe not all the way good, because for those of us who've been on these calls enough, we all understand that employee or employer sponsored life insurance is not for the employee, it's for the company. The company is insuring or protecting their loss in the event that one of their employees doesn't show up to work one day or 1 year or some years down the line, because hey, that's what we use income protection for, to cover our financial losses. If you're an important person in a business, of course, a business is going to insure their key employees, person insurance, right? So, here it is that we're talking to her about that. She says, oh, I got the insurance for my job and I got the 401k for my job, but I also have a 401k for my business. I'm like, oh, okay. So it sounds like you've already got a financial advisor. She's like, yeah, but we're not speaking so much as frequently as we used to. So okay, but have you talked to your person, your advisor, about having insurance for your actual 5 to 9 grind? And she's like, no. It's like, well, if you lost the job from the 9 to 5, and it was because of something that either you got sick or you got hurt, and it affected your ability to get insured, well, it sounds like you might have to depend on your business, your 5 to 9, way more heavily than you do on your regular employment, right? She goes, huh, that's a good point, right? And it's a very good point. I want you guys to think about that. All right. So, I'll come back to this example of a story a little bit more, but let's keep moving, right? Um, Want to have your insurance for your own business, okay? And hey, maybe while we're on the subject of businesses, a trust can hold or own a business. All right. So if you've got a business, right, but you've done your necessary estate planning, you want to keep some things private. All right. Let's get out of credit. Let's get out of private. Let's get into privacy, because that's ultimately what a trust is designed to do. It's designed to give you more privacy. Let's increase that a little bit. Let's bring that forward. Does that help? Okay. Right. And let's bring that font size back down to 12. Thing. It did the thing. We thought about it in advance. We just changing the font, right? Like that. Right. Privacy. Anything that happens within a trust is essentially shielded from public record. Okay. So this is for, we're going to call this the veil. Oh my goodness. Why you do me like that? Yes, the whiteboard deity said, I want you to really understand how important this veil is to your business. All right. How important this veil of privacy not only protects you legally, but also your business legally, and it also shields your beneficiaries legally from public information, all right, or having your information made public to the business, to the rest of the world. All right. So there's a veil of privacy. Let me go to the chat real quick, because I see we got some comments coming in there. Once the trust has all accounts, including business, what changes or what is being protected? Okay. So excellent question, because that's actually where we're at right now with the privacy. What are after all the changes are made, what is being protected? The things that are being protected are your number one, who owns what bank accounts? Think about that. Okay. Bank accounts. Well, the trust, hey, there are way more benefits on the tax side for trust, and I'll touch on those in a second. But what we're basically changing is the public's awareness or access to the information. Okay. If you've got property and it's transferred via a quick claim deed, yep, I'm giving you some source. This is some seasoned Classico sauce. All right. This is the Classico. All right. So you got you got your property that can be quick claim deed transferred into a trust. Why would you do that? Well, because property held in trust is owned by the trust, not by the individual. The individual has made the conscientious decision or has come to the awareness that they can't take the land with them. So they're acquiring land, they're acquiring property, not for their own interest, but in the interest of those that they may leave behind. So, question becomes, who do you want to get your stuff? Do you want it to be your family or the people that you love? Or do you want the government to get your stuff? All the work that you've done for however many years you've done it, do you want Mr. Sam, right? Because he's no uncle of mine. Do you want Mr. Sam coming and putting anybody, anybody? I'm not hearing any yeses, so that tells me you're all by acquiescence saying no. Okay.
It broke up. I didn't hear it. It broke up. I didn't.
Okay. Well, does
Do we
anybody
want
want their
Uncle?
benefits going into the hands of Mr. Sam?
No.
No.
Absolutely not.
So, that could be not just, your bank account, because hey, if you die without having any estate planning done, your family or those that you leave behind, those that survive you, right? And no, this isn't some surviving Diddy conversation, all right? This is no surviving Kelly conversation. We're talking about those who you leave behind after you've made a transition in existence, okay? So those that may survive you, you want them to get the things that you've worked hard for, right? If you don't have any estate planning, you'll be like over 70% of the US population who dies without an estate plan done. All right. Which means your family will have to go to the court, your local, county, or state government. And for those of you who are international, even your international government, to have letters of administration or authorization for someone to now act in the capacity of executor, custodian, or trustee of your assets. All right. Which means now that the government, the state, the Fed, the international country, government, now that that's had to step in, they're going to tax you. And by tax you, I mean charge you 45% or more just to stay who's going to administer and operate or act as the executor of your estate. Anybody okay with like just giving the government 45% of their hard-earned stuff?
No.
So
No.
I gotta ask, I don't know. I see people going to mute. Some people might fall asleep. It's just another way that I can get a little feedback as to whether or not what's hitting. All right. But, and not even but, just an and at 45%, that could totally wipe out someone's financial standings. All right. Let's say that you've got property. You're still paying the property off, right? Not just property taxes. We're also talking about a mortgage, a loan, right? Maybe you've got other debts, right? Here it is that if your family depends on your income, more than 50% of your income to maintain financial stability, that's a liability that you may want to address as early as possible. Okay. And for those types of financial responsibilities, you should think about having income protection in place to take care of some of those debts that you might leave behind, like a mortgage, which means that your insurance, which a trust can also be on, right? So let's talk about privacy. A trust can be listed, designated beneficiary. All right. And for those of you who may be married, or you have a domestic partner, All right. And for those that maybe aren't familiar with that, like what is domestic partnership? You know, interestingly enough, result of uh the state trying to stay out of the institution of marriage, right? So, and I say that, why do I say that the state is actually trying to stay out of the institution of marriage? Well, because it's a marriage on paper without you having to go involve the court or anything else like that. At the very least, all it requires you to do is just have an agreement between you and your spouse, your significant other, things like powers of attorney, you know, things for both financial and medical related stuff. If you're not married and you're a young couple, but you just had children, right? A domestic partnership may benefit you in expressing who the parents of the child are. So that way, because there's no marriage license or certificate, bear in mind that the state does not allow, you know, what's the word I'm looking for? Third parties into a hospital room or into a courtroom. They only let people with firsthand knowledge into the courtroom, into the hospital. So a domestic partnership agreement, like a trust, or even as a trust, as a joint AB trust, okay, can be used as a designated beneficiary to state that in the event that something happens to the person that is on an insurance policy, on an investment, or you know, some on a loan, that person's estate will pass on to the people listed in their trust. Okay. So, but if you're married, like with a certificate, not just a wedding band, right? What you can do is you can list your trust as a secondary beneficiary. All right. Meaning your spouse, whoever it is that you're married to, maybe you want them to have immediate access to the account, right? But in the event that something ever happened to them, the trust being the secondary beneficiary or the alternate beneficiary, right? That survives the spouse. You see what we're doing? We're creating a line of succession, all right? Meaning a line or a path for anyone else to follow, right? This is what my whiteboard shows. Will you please share it complete when you can? Okay, I certainly will. Okay, wait, it's not visible? The whiteboard is not visible? You guys can't see it?
No, we can only see up to where it says credit and then authorized user accounts. So there's a lot of space in between trust, the benefits, and then credit, but nothing else after that.
No, I gotta fix that. Let me fix that. Let me make sure. Maybe can you see everything now?
No,
All right, six.
I think you have to adjust that, the lines. Okay, a little bit more. We can see privacy. Oops, it disappeared.
Privacy.
Yeah. Are you able to stretch the corners or decrease it and then move the that whole text? Is that a box you're typing in? A text box?
Yeah, it is. How we're looking now?
Okay, now that's much better.
Okay.
Pull it down a little bit more from the bottom. If there's anything else after the second bullet under privacy.
What all
Any,
exactly should we be seeing? Other than
well,
trust benefits and then privacy below it. Is that all that you're trying to show us?
yeah, right now that's basically all I'm trying to show.
Okay, we see it. We see
You
it.
see it.
Okay. So, and now let me see. Dot. This is what whiteboard shows. Okay. So designated beneficiary, for those of you who may have, life insurance, investments, loans, you list your trust as a secondary beneficiary, your spouse as the primary, so that way in the event that something happens to you, your spouse still has immediate access, or your domestic partner still has immediate access. And just in case, reasons to go ahead and get those powers of attorney, because you're going to be able to challenge something that's got that notary stamp on it. All right. It's admissible in court. Trusts are admissible in court. Declarations of the trust, although you never want to provide that information into like a court forum, because now it isn't the court's record also public information.
Okay.
Yeah. So,
Yeah.
so we don't want the court's record to even reflect that. So there are some assets that maybe you don't want to place into your trust. Things like maybe a car, okay, are things that you don't want to put into a trust, because if you're ever in a car accident, well, now the trust has to disclose some of the other assets held in the trust aside from just the car. So maybe you don't want to put the car in there. Maybe you don't want to put the house into a trust until after you paid off the mortgage. Why? Because if ever they decide to accelerate the loan, well, that might not be a good thing. However, because banks do sneaky stuff like accelerating a loan, if you are operating the payments out of a trust for the loan, then it makes sense that the trust should be listed as the designated controller or holder of that property in due course. All right. Um, so and of course, then you're saying that this other entity, not you, but this other entity is going to be responsible for taking care of the payments towards satisfying the obligation to pay, right? So there are some of your benefits. Some of your primary benefits is basically keeping your public information, or the information that normally might become public, as private as possible. Okay. I see we got some other stuff in the chat. Let me check that real quick. 9 to 5 insurance, personal business insurance. Yes, that's a possibility. That is definitely an option. Okay. What specific insurance should be considered? In my opinion, and insurance is a topic of what does the individual need to protect their best interest, right? So would that be like workers' comp? In a way, you could look at it like workers' compensation, except now it's no longer just tied to your job, and you no longer have to be actively employed through your job in order to receive any portion of the insurance policy that might benefit you during life. Say, for example, if you were to get sick or terminally ill, right? So in my philosophy and in my opinion, insurance is not a lifetime solution. Okay. And I'll say that again, insurance is not a lifetime solution. It is a means of protecting your income for the time period of which you may be working. If you see yourself working for a very long time, then sure, you might want to have an insurance policy that lasts you a long time, or just be prepared to renew it, and just quite frankly be prepared to pay higher premiums on a monthly basis the older you are on waiting to get that private insurance. So now, because whole life insurance tends to be up to 10 times more expensive than term life insurance, and because we're thinking about people's finances, and I want you to have more money to actually do what you want to with, I think that it's in your best interest, or just in general, everyone's interest, to consider a term life policy for the period of time that you're going to be actively working. So, the question of when do you see yourself no longer working for money because you have to, doesn't mean that you're going to stop working, right? It just means you're not working for money because you got to pay mortgage. You're not working for money because you got people that are financially dependent on you, right? We're talking about all those other responsibilities, financial obligations are finished, right? Let's use the instance of new parents got a baby that's under 1 years old, right? You're young, how long of a term life insurance policy should you consider? Maybe, if you're under 30, I think that a 30 to 35 year term policy could benefit a lot of people. And because it's a long duration of time, and because that applicant would be young, the cost of the insurance would be significantly lower for a large amount of coverage, right? In comparison to someone who may be in their 50s, in their 60s, they're closer to the retirement age that most people look at as 65 or 67, when really they should be thinking about 59 and a half, because that's when the government says, hey, you can touch your 401k without us smacking that hand for a 10% penalty, right? So given that everyone on this call may have a different period of time that they may be working for, it's going to be in your best interest to consider, well, how long do you expect to work? And how much do you need to stop work? Most importantly, right? Because I want to really get away from the conversation of insurance and really get into the conversation about investing. Okay. And like that's part of the reason why I touched on credit, because, well, people will think about credit, and with credit, if there's a borrower, there's a lender. If there's a lender, there's a borrower. If there's a creditor, there's a debtor. If there's a debtor, there's a creditor. All right. So creditors actually oftentimes will insure the debtor, so that way, in the event that the debtor is unable to pay their financial obligations to the creditor, the insurance company is that a hand up? I'm not sure if that's a hand up or that's a hand up. So if you got a question, go ahead and unmute yourself. I'm gonna just touch on some of these extra points real quick. But yeah, depending on your age, you need to consider how much money you need to have to stop the working in the rat race altogether. Okay. So how much money does that look like for each of you? That's going to be different. For me, when I did my first financial needs analysis, my target income or amount in savings or just in total net asset value was 1.5 million. All right. Now that's my number. Somebody else's number might be 2.5 million, might be 3 million, because they've got families, right? Maybe they got a bigger family than I do. Okay. And my little small family of, my 3 kids that I produced, hey, 1.5 seems to do it for me. And I could feasibly, realistically retire at age 60, not have to worry about tax penalties or anything else like that. But if I have that 1.5 million, I don't need to think about insurance at that point. Do I? Probably not. I can cover the cost of most of the emergencies that might come up, right? But someone else, maybe they've got health problems. So health insurance, maybe that's something that they want to consider. Not a problem for me, so I don't incorporate it into my financial planning. However, healthcare, when I get older, is going to be something that I need to think about, because the way I'm moving and the way I'm pushing, you know, if the good Lord decides to bless me with someone who's going to be like, I'll take care of you, that's sometimes what we used to think about our children as our retirement, and let's just call it that too. We are at an older generation. I think that the family institution was looked at as another means of creating a retirement plan, right? Like a social benefits. You create a big family, that means, and with a big family, you've got a large estate because you've got everybody working on the property. That's just maybe that's just antiquated thinking. And maybe we no longer live in that day and age where we have to think about, well, my little house on the prairie somewhere in Wyoming or Minnesota, right? Or South Dakota, where the anonymity laws are favorable, and so are the taxes. You never know, right? But that's part of my long-term plan, my long-term thinking. I know where I want to be at. I know how much it's going to cost me, but I can't say that everyone else can speak to the same effect. And that's what we want to kind of change. All right. So let me see. I heard they never pay out term life insurance. That's a good comment. And that's exactly why I want to get away from the insurance conversation because one, the way that my partners in my office, the way that we do things in our office, we have what's called a premium recovery strategy. So, and it's there's nothing to be apologetic about, like the facts of the matter are what they are. Term life insurance never pays out. In fact, whole life insurance typically never pays out more than the actual coverage of the policy. The things that go into whole life cash value policies or index universal life insurance policies or infinite banking policies do is they have you oh, we're gonna go back to the money. This is how we're gonna go back to the money. All right. Whoa, I gotta go. Where you going? I gotta get back to the money. I'm sorry. I like a little Wayne every now and then. A little Wheezy baby. Okay, so let's get back to the money. Term life insurance, whole life insurance. It's the insurance company's goal to not have to pay out on the policy. All right. Ask any licensed life insurance agent, right? And they will not tell you this. They will not tell you this because it destroys the illusion that, oh, this is an investment when it's not. The IRS doesn't call it an investment with the whole life insurance or an IUL or an infinite banking, right? And so, because of those things, there are much better ways to spend your money than to put it into life insurance because, oh, I get a dividend. Oh, I can borrow my money. Well, in regards to the dividend, the IRS says that it is no more than a reimbursement of an overcharge on expensive insurance premiums. Okay. If you're getting any type of dividend from a whole life or an IUL or an infinite banking, well, think about that for a second, right? Because an insurance company as an investment means that the customers and the owners are the same people, right? And if you actually look at how much the actual cost of insurance is and what's being left over, as far as like what can be borrowed, well, when there's a borrower, there's a lender. And lenders charge an interest rate to repay whatever you borrow. Well, Prince, it's my money. You're right. It is your money. It is your money. Why should you have to pay interest to borrow your money? Unless someone is counting on you not being financially responsible enough for your money, than to just put it into an insurance policy where you can borrow against that. I talked about this a couple of weeks ago, actually, too. One of the clients that one of our other partners, uh, our nurse and doula, who's on the call, we were having a conversation, doing a financial needs analysis for one of her clients, who was paying $9,600 a year into insurance. The actual insurance cost him $1,800, and the remaining difference he was able to borrow against. But now he's borrowing that money to pay off credit card debts. And then when I ask him the question of, are you paying one bill a month or are you paying two? He says, I never thought about it, but I'm paying an insurance premium and I have to repay the loan every month. Couldn't he just take the difference of what he's not spending on life insurance, still pay off his credit card debts, leave himself some additional money, and not have to worry about paying an interest rate to pay back money that was his in the first place? Okay, so we're on the money. What a scam. Still confused about money. Scam, still confused about money. That's right. Bing, 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 bing. We got to make that a thing. You know, whenever we hear that at least once every call, you know, a scam.
Mhm.
Whenever we need to do that, you know, whenever somebody says scam, we need to go crazy. We need to go ape stuff. All right. But yeah, you know, it is a scam. And if you didn't know, it's because the insurance agent, again, the insurance agent does not want you to know because they benefit by taking a much larger commission for the first 2 to 5 years. And then those policies, they don't have any cash value. And then when they finally do, it's based on what you put in, right? So in the illustrations that those characters use to show people, oh yeah, like if you invest this much every year, and you know, what they don't tell you is if you don't borrow from that money at a certain time frame, yes, you'll have this huge amount of money that looks to be stockpiled in there. But most people do what with the money that they have stored up?
They borrow it or refinance?
They borrow it. Well, when it comes to refinancing, and you know, that might be a conversation for another time, but you know, refinancing can work in the interest of the consumer for when the interest rates drop, right? Like, let's say that you bought a house, you know, the interest rate on that house was, let's say, 16, you know, 8 to 16. Let's say that it drops still to 4 to 8%. What would most people do? It's a perfect time to refinance. Why? Because you're paying less on the interest and pay off the principal faster. But then most people don't think about paying off the principal faster. They just think about, well, I got a high interest rate. And then they're not, like, it's so confusing. The fact that they believe they have a high interest rate. No, you're paying a high interest rate. You don't have a high interest. It's not an investment. That's a debt, right? So we're not talking about a debt in this case, but we can always talk about clearing up debt and helping people pay off their debts faster by understanding how those interest rates affect their credit or their loans. Okay. So I'm glad that you're saying interesting also because, you know, we had conversations and I know you expressed to me, oh, the information is really long and I'm trying to figure out ways to make it more impactful. I didn't know that. Oh, I didn't know that. That's the point of these calls, right? To get people thinking, oh, I didn't know that I could do that. Well, if you don't know, now you know. All right, guys and gals. So, um, when we do a premium recovery strategy for our clients, we talk about looking at number one, cost of their insurance. Then we calculate actually how much we need to put into an investment, not a savings account at their bank, but an investment that's going to offer them a 9% or higher interest rate on that investment. Okay. Now, IULs, whole life, infinite banking, they don't give you anything greater than 5 to 6%. They do not give you anything greater than 5 to 6%. They have you capped. And if there's a ceiling, there's a floor. So the floor is what most people are interested in because the floor means you can't lose. You can't go below 0%. So if the market does poorly one year, you're guaranteed not to lose, you know, or go below 0%. But you only will be allotted that 5% to 6% spread. The example I also like to use every now and then is that last year in 2023, Standards and Poor did 15%. If S&P 500 did 15% last year, and you had an index universal life insurance policy that only capped you at 5 to 6%, who keeps the additional 9 to 10%? The insurance company. And then here's some more interesting stuff, guys. The client doesn't get to keep any part of the investments or the savings unless they live to age 100. when that whole life policy or that cash value life insurance policy actually endows. That's absolutely right. The house always wins. They do not want to pay out. Going back to the question, the insurance company never wants to pay out on the policy, which is again one of the things about term insurance that a lot of people complain about. Oh, it doesn't pay out because most people live longer than the term. So our industry is not about you dying so that way you can pass on some benefits to, or, an asset to your loved one. Who wants to have that conversation? Oh, my family's going to inherit $500,000 worth of money if you die.
Mm.
That's depressing. We got to have conversations around people dying in order to pass on wealth.
Mhm.
Why is that? Right? And the reason why is because TikTok makes it cool, Instagram makes it cool, Facebook makes it cool, only because the majority of us don't understand the insurance industry, right? So now that I've got you thinking less about insurance and thinking more about where's the money, let's get back to this money real quick, and then we can go ahead and call it a quits for the evening because we're at the top of the hour. Talk about an exciting call today.
Okay.
I hope that a lot of you all have gotten some great value out of this, right? But let's talk about the money, okay? Because again, the insurance company, they never want to pay out. In the strategy that I'm introducing you all to, our premium recovery strategy, we looked at exactly how much your estimate on life insurance is going to be. If that's not within your budget, we adjust it. We work with everyone, okay? Fixed or limited income, it doesn't matter, all right? For some of you, that are on this call that may have a little bit more life behind you than you do ahead of you, right? And for those of you who are on this call that have a little bit of life behind you and a whole lot of life ahead of you, I want you to consider this, all right? Number one, I want you to purchase the lowest amount or the maximum amount of coverage for the cheapest price, and not cheap as in it's a poor quality, a poor product. I mean affordable, something that you're not going to bat an eye at, okay? Some people that's $25. Some people that's $16. Some people that's $300. For the guy that, our nurse and doula was talking to, hey, that could be, that was $9,600. Thank you for joining us, and enjoy your next meeting, right? But for some of us, that might not be might not be what we want to be spending our money on, right? $9,600 to go towards just life insurance, right? For the difference, he could have put the difference into an investment that was growing annually at 9% or better, right? And then think about that. He's basically making his insurance free by having an investment that he'll be able to use, take for, make withdrawals against and not have to pay any money back to take his own money, right? None of that. That's what we want to do for people. We want to show you. So for anyone that may be interested in seeing more of how we do that, feel free to contact me. I'm not going to hold you guys up, but for those that maybe want to talk about that, real quick, did I do a good job today of talking about the benefits of what a trust does, like for the rest of your estate planning, your rest of your financial planning?
Mhm.
Thank you guys. All
Yeah.
right. I'm not one that is compliment hungry or anything like that. Info must charge for. I appreciate that. That just means that someone thinks it's valuable. We got $1 million information on this call, guys and girls. All right. But what I'd like to do is also extend an invitation to you all to come back next week. We will talk about the premium recovery strategy for your estate planning. Okay. I'm going to show some people how we balance out their insurance with some investments, and rather not insurance with investments. We're balancing investments with insurance. Why? because the investment money is yours. You can do whatever you want with it. And if you start your investment with us for the term that you have your life insurance policy for with us, right? Like whether that's a 10-year term policy or a 35-year policy, at the end of that policy, you're going to have invested an investment income equal or greater to what you paid for insurance on. And if you guys want to see that, I don't know, maybe just a little nibble, a little nugget. You guys want to see that next week? I'm happy to show that to you guys, right? Because again, a trust can have an insurance policy or be a beneficiary on an insurance policy. An investment can be listed as a beneficiary on its survivorship clause, right? So, for those of you that are interested, we'll go ahead and definitely talk about that. I'll show you the premium recovery strategy.
Yes.
All right. We're gonna be making I'm gonna show you guys how we're making millionaires. All right. I saw a little baby head with some cute, soft looking hair on the call just a second ago. I'm gonna show those parents how to turn that baby into a millionaire by 18. All right. Have a baby by us, baby. Be some millionaires. Okay. And as 50 Cent would say. But let's go. I appreciate you all. Any questions before I close this out? Probably a good opportunity or a good time to maybe take a quick picture of the screen in front of you. So that way you've got like some notes or, just screenshot it if you got that kind of technology. But if you're on your laptop and don't know how to screenshot your laptop, get the old mobile device out and, do it the old fashioned way. At least it's not a Polaroid that you got to shake, right? You don't have to shake this picture in order to get that information. You just snap and you're ready to go. I am going to take a quick little picture of this. I'm going to put this on my social media feed. Below your faces. So I don't want anybody being like, oh, he took a picture of my face. He took a picture of my face.
I appreciate this information, brother. It's something that I'm very new to, and a lot of this is very important. I appreciate it very much, very highly.
Absolutely, brother. Thank you for coming on this evening too. We're doing our best to make sure that we're taking care of not just our generation, not just the last generation, but the next generations, right? So 3 generations ahead, while some of us still have to look 3 generations behind, all right? So we're taking care of families, we're taking care of our elders, we're taking care of our parents, we're taking care of our kids, and we're taking care of our grandkids, right? And our great-great-grandkids as well. So, yeah, we never know how far or how many lives we may be touching when we're doing this estate planning and this financial planning, but the goal is to change the narrative for our community of individuals who look like us, who think like us, and maybe that we're just breaking bread with on a regular basis. Poverty and taxes and death are the great equalizers. All right. It doesn't matter where you come from, what color your skin is. If you don't do your planning, you're planning to fail. All right, guys. Really appreciate you all being on this call tonight. Looking forward to seeing you all next week where we talk about our premium recovery strategy, how trusts can benefit from this information, how your beneficiaries, your loved ones, your spouse, your child, everybody, whoever you want to take care of, let's leave no stone unturned. All right. Have a great evening, guys.